In 1972, Wall Street decided that 50 companies could never lose. Coca-Cola, Disney, McDonald's, Xerox. The best businesses in America. So investors paid any price. Any price at all. And then, they lost almost everything. Right, the best companies. The worst investments. I've watched this exact mistake repeat for 50 years. Different names, same story. The Nifty 50 weren't junk stocks. These were the crown jewels of corporate America: real profits, real growth, real dominance. That's what makes this story so dangerous. Because the companies were right. The price was wrong. And by the time it was over, a portfolio of the safest stocks in America had been cut in half. Here's what most investors still get completely wrong about it. The idea was seductive. Simple. And that's exactly why it spread. By the late 1960s, big money managers had a new theory. Find the 50 finest growth companies in America, and just hold them forever. They called them one-decision stocks. You buy once. You never sell. The growth does the rest. And honestly, the logic wasn't crazy. These businesses were extraordinary. McDonald's was opening restaurants across the country. Xerox owned the copier. Polaroid owned the instant camera. Coca-Cola owned the world. So pension funds piled in. Banks piled in. Everyone wanted the 50 perfect companies. But when everyone agrees a company is perfect, something strange happens to the price. Draw, great business, everyone agrees, everyone buys, price explodes. Here's where it gets uncomfortable. Let's talk about what people actually paid. A price-to-earnings ratio tells you how many years of profit you're paying for a stock. The market's long-term average sits around 15 to 20 times earnings. The Nifty 50? They blew past that. In 1972, the group averaged around 42 times earnings, more than double the market. But the averages hide the madness. Look at the individual names. Polaroid traded near 90 times earnings. McDonald's around 86. Walt Disney about 82. Avon near 65. Think about that. At 90 times earnings, you're paying for 90 years of profit. You'd have to live to 100 just to break even at that rate. Right, 90 years of profit. Paid up front. Investors told themselves it was fine. These companies were different. They'd grow into the price. It's the four most expensive words in investing. This time it's different. And the reckoning was already on its way. January 1973. The market peaks. Then the floor gives way. Oil shock. Inflation. Rising interest rates. The 1973-74 bear market became one of the worst since the Great Depression. The S&P 500 fell roughly 48% from peak to trough. But the safe Nifty 50? They didn't fall less. They fell more. Because they had the furthest to fall. Polaroid dropped from around $149 to near $14. A 91% collapse. Avon fell about 86%. Xerox got cut down brutally. Company after company lost 60, 70, 80%. And here's the cruel part. The businesses were mostly fine. McDonald's kept selling burgers. Coca-Cola kept selling Coke. The earnings held up. It was the price that had been insane. Draw, earnings, steady. Price, collapsed, the gap was the bubble. Investors didn't lose money because they picked bad companies. They lost money because they paid bad prices. Now here's the part that changes everything. And almost nobody talks about it. Decades later, in 1998, Professor Jeremy Siegel went back and ran the numbers. He asked a simple question. What if you'd bought the Nifty 50 at that insane 1972 peak, and just held? The answer surprised everyone. As a group, They roughly matched the S&P 500 over the following 25 years. So the buy forever crowd wasn't entirely wrong. The best businesses did eventually justify a lot. But look closer, and the truth splits in two. Philip Morris, Coca-Cola, and Merck grew so fast they earned back even those crazy prices. But Polaroid? Kodak? Xerox? They never recovered. Technology passed them by. The lesson isn't great companies always win. It's that even great companies can be ruined by the price you pay, and you won't know which ones survive until it's far too late. Right, you can't control the business. You can control the price. So what's the real lesson from the Nifty 50? It's this. The quality of a company and the quality of an investment are two completely different things. A wonderful business bought at a foolish price is a foolish investment. Full stop. As Buffett put it, price is what you pay. Value is what you get. The Nifty 50 investors got the companies right. They just forgot to ask the only question that ever really matters: at this price, is it still worth it? Right, great company. Wrong price. Equals loss. So let me ask you this. What's a can't lose stock everyone's crowding into right now, the kind people say is different? Drop it in the comments. I read every one. And if this changed how you think about paying up for quality, hit subscribe. We do this every single day. Tomorrow, we're looking at the crash almost nobody saw coming and the handful of investors who got rich from it. Remember, this is educational content, not financial advice. Always do your own research. Past performance never guarantees the future.